Hello, welcome back, guys. I have long talked about how I like Palantir as a business, and in our even in our Discord discussions, I have always said that I like the company as a business for what they are doing, but I hate the stock price. I hate what the actual valuation is. And you can see here that the company got 10%, actually was 10% up yesterday. There were some news about it, which we're going to examine and see why that happened. But it's a 19 billion market cap business, which has some very high ratios here, but it's down 70% almost. And so I'm trying to find the sweet spot, place and price to buy this token. Right now, sitting at $9, it may be interesting. We're going to examine that after it has fallen so much. Pretty much the price has fallen down to oblivion, but we want to see whether it's actually a good buy here, and that would depend on whether it would be a nice addition to a portfolio here. Now, first things first, if we take a look at the stock news module here, you will see that Palantir is a buy, why Palantir is up, why Palantir stock popped. It's pretty much talking about it, and I have an article here which is explaining what happened. This move occurred after the company announced it was awarded a larger contract from US Space Systems Command. And this expansion of scope has resulted in an additional 53 million of revenue. Of course, as you can understand, for this company, this is huge. As you will see here, an additional 53.9 million is added on top of an existing 121.5. So this is a significant increase in the revenue that the company is going to be generating. And you can understand that the Wall Street actually liked that. And you will also see that contract modifications happen all the time when a client like this likes the work a given company does. They expand the scope, and this could add more dollars, of course, as you can see. And for Palantir, and this is a very important point here, it's perhaps less about the money than who the client is. And I completely agree with that, because this expansion is aimed to assist like Air Force, Space Force. You will see that this is obviously very, very important players to add to your arsenal of customers or clients, I should say. And so with all these, geopolitical tensions wrapping up and a little bit of control going on, and the discussion of why more data needs to be accumulated, you can understand that this kind of company, I feel, is a very, very interesting potential hold. And this is why I wanted to talk about it, because it is one of the companies that I would love to have in my portfolio. Again, as I mentioned, yet I will not overpay. This is very, very important for me, because I want to be making money, and the best way to make money is to never overpay, buy things that are fairly priced. Now, you will notice in this one, P ratio is negative, which means that the company is actually still losing money. Remember, this is a new IPO. We can kind of take a little bit of a close look here at when the company IPO'd in 2020, back in September. It's a relatively small company, as you can understand, and it's still pretty new in their operations, at least as a public company. And if we go back to our stock analysis chart here, you will see that the price to free cash flow is at least positive, although pretty high, and the company has been issuing shares like crazy. I mean, it's in the early IPO stages. They are still issuing shares. Their most shares were actually issued on IPO date, which happens about like a few months later or so. It's very, very typical that the company keeps issuing shares to fund themselves. This is why it's not a good idea to be buying at IPO days. But this has slowed down a little bit, as you see, from 2021 December, that is. It's still a little bit more, but much less. So it's about the same, a little bit more. Now, the company has quite some free cash flow, it looks like, or they don't have enough liabilities. So 3 years of free cash flow, of last year's free cash flow to pay back all the total liabilities is very fair. Now, the 5-year revenue growth, look at this, it has been increasing, and it looks like it will keep increasing. Again, we just talked about what happened with the new contract here. Now, the net income growth has been increasing just a little bit, but remember, they had a massive slump, a massive drop here. So they're going back to positive territory in comparison to what they were doing in 2018. Yet, they are still non-profitable, and that's a concern, of course. Free cash flow growth has been doing much, much better, and they are in the positive now, which is a pretty sight to see, of course. Now, they don't have a lot of debt here. They have a lot of current assets compared to current liabilities. Of course, the returns are negative because the company is not profitable. But let's take a little bit of a look here. What's going on the income statement? 500 million to 1.5 billion is pretty fair over here. And look at this, net income is basically the same. They're still losing money here, and that's a concern, as you can understand. We do want them to achieve profitability soon, and they will have to, in order to be much more attractive target really for potential investors. And in terms of total equity, it has been increasing, but remember, additional paid-in capital is the gist here. They have been getting money from stockholders, not their operations. Now, the cash flow statement points to a company that is not making a net income, of course, it's negative, yet when you add back all these non-cash-based expenses, you are getting some positive free cash flow here. Of course, you want this to be derived from positive net income if possible, so this is not a great picture to see. And at least it's doing a little bit better than last year when they actually lost more money. Now, investing activities here, just a little bit of investing, some purchases of investments, for example, not much to see. And in terms of financing, getting some debt is the norm over here. They do have 2.3 billion in cash. Now, let's take a look at the stock evaluation tool. Is there a price to pay for this one? This is an interesting question. We will see the revenue growth of the company has been pretty solid here. So I will go high. Let's just go 18, 20, and 22. The net income margins are the big problem here because the company is losing money. So when this happens, we generally speaking want to assume that the company is achieving marginal profitability, let's just say 1, 3, and 5%, and see how close we are to the current price of the stock. And the free cash flow margins, again, they are pretty much coming from from a non-profitable company, so we do have to use something that's rather typical. We don't have enough data to go with what the company has been doing, and so we're gonna say that this is gonna be 80% of the net income, 90% of this net income, and 100%, 5% pretty much. So if we hit calculate here with a 13% annual return, you will notice that the company is very expensive based on what they are doing, because their free cash flow generation is problematic. They are not making enough. And as you can understand, this plays a very massive role in how to evaluate this company. And if you assume better margins here, if you assume that the company achieves maybe some better profitability and they go 7, 9, and 11%, for example, things are going to be much better, as you can understand. We are at a high of $2.2, but the current price is 9.3, and so we are very far. Now, if the stock price went maybe $2 or $3, maybe you could just play it for a little bit of a potential trade and just give it some time, but it would be still risky, although you would have less risk because it has dropped a lot, okay, but still it is overpriced, and as a long-term investment, at this point I can't see myself entering this company. It's expensive, even after having fallen that much. It's still very expensive because it was very hyped up. I mean, people kept buying for a long time and they were selling it higher and higher, and then the drop would have to happen at some point. But it was about like 40 at some point over here, more than a year ago. But yeah, it's at the point that I can't see myself entering and buying right now. Look at this. I mean, yeah, it went high and then there was a massive slump after that. So yeah, it's interesting to examine, interesting to see what they are doing, and maybe in the next few quarters or so, maybe next year or so, they will be achieving better results, and if we re-examine them, they may be a better potential buy if the stock price remains low, and even lower potentially. But right now, I think it's expensive. Thank you for watching the video. Remember to leave a like, that really helps, and subscribe if you're not a subscriber. And of course, you remember that you can always join us on Patreon and get access to this tool, or even Discord, and come chat with us. You can find all these links in the description box below this video. Thanks for watching, and I'll see you soon. Bye bye.